knew that we've had these economic worries, sort of some percolating talks about impending recession potentially coming back up again yesterday. What's going on now?
Well, listen, I think the Treasury auctions are very important this week. And yesterday, after the three-year auction at 1 p.m., there was a little bit of optimism. Markets lifted off of the lows. There was a belief that, and there was, the demand was relatively strong. What's happened here this morning is that price is now reversed a lot of that optimism that was represented in an end-of-day bounce, and now you have broken below yesterday's low. So a little bit of technical selling pressure. I think there's more nervousness in the 1 p.m. 10-year auction is critical today because we've seen the long end of the curve where yields have been backing up. That's where this battle is going on right now with the asset management industry that's long duration, and then hedge funds and speculators like Bill Ackman who are short treasuries. So the 1 p.m. 10-year treasury is going to be important. But look, overall, this is a market that's doing what it's supposed to be doing. I think this is healthy. It's correcting. It's targeting the 50-day moving average at 44.27. And the market coming into the month of August was clearly in need of a correction. And again, the price of oil is another element that's not helping the overall sentiment.
Amy, UBS is out with a note today also expecting more volatility coming. They're talking about expectations for a minor recession, which does sort of echo some of the notes that we heard yesterday that it seemed like the market was focusing on. Are you worried about a recession, and how key is the CPI number going to be for you, your portfolio, and what the market's expectations are about what the Fed's next move may or may not be in September?
I think it's a little early to worry about a recession. I do think we will get a recession eventually, but it doesn't feel like it's in the next quarter or the next 6 months. So I'm not as focused on recession, but typically when you see this big run up in multiples like we saw in the first half of the year, that's followed by very strong EPS growth. And I don't think we're going to get that. I think we are in for choppy waters. And as Joe was saying, the CPI is important tomorrow. There is a weirdly hard compare, July year over year. Last year, July, the CPI was lower. So I do think this could be a noisy number. But when you look at when the CPI and rates diverge, like we're having now, rates tend to be more important. And in all instances, except for one, it was you were right to follow what's happening in rates. So if rates continue to go up, yes, I do think that we're in for some choppy waters for the next 6 months.
What do you think the chances of some strong volatility tomorrow are, Weiss? Obviously, we've seen a lot of volatility almost every time the CPI numbers come out over the last 12 months in either direction. What are your expectations, and how should everyone be positioned ahead of this number?
How should you be positioned? You should be positioned in the stocks that you like, that you value long term. I think it's very difficult to play a number, and is generally a losing proposition. So given where volatility is now, where the VIX is, and you should have protection in your portfolio anyway. But here's what's contributing to it. The market was in an overbought position. Joe and I talked about that right before the decline. Timing was prescient, more likely lucky, because that's just the nature of the markets. But then what have you had in the interim? In the interim, you had a downgrade of the U.S. credit rating. Not a big deal. Ultimately, it means, frankly, nothing. But you also had then downgrade of banks. So, they weren't happy with one rating agency being the headlines. They figured, how am I going to get back in the headlines, right? So they came downgraded some banks.
Talking about the Moody's report.
Right, the Moody's downgrade. And so that added to it. Then you're hearing the statistics on credit card balances and credit card delinquencies. So that's creating some more nervousness. So when you put all that together, as well as Joe mentioned, rising oil prices, which it's too soon to filter into core CPI, you may see in top line, it's not too soon for it to start filtering into core PPI because of the feedstock. So they ignore oil price from top line because the Fed focuses on the core. So you've got all those now, headwinds, whereas everything was a tailwind before, soft landing, et cetera, et cetera.